So this is Mr. Runkey.
Hello,
I'm
Mr.
Josh
Runkey.
Howen. I'm a CPA. I've done tax talks through the years for Keller Williams. This is the first time we've done one digitally and remote, which we're happy to give a go. And y'all asked us to go through realtor tax strategies. Exactly how we title that is up for debate. I think the investor's tax playbook. We're going to get to the same place. So we're going to cover a lot of minutia about real estate and taxes. And a lot of those things are going to touch on investors, but there's going to be other things peppered through there that investors may or may not need. But the super majority of what we're going to talk about is going to be related to investors and real estate.
Awesome.
So the realtor or real estate tax strategies, we know this type of this type of tax and this type of situation, this type of investment back to front. We prepare many tax returns with real estate. We prepare tax returns for realtors. We prepare tax returns for people with residential investments, commercial investments, kind of a little bit of everything. So we've seen everything. Personally, I've had real estate investments as well, of all different categories. So we've seen it from all the different angles. So we've got tons of experience with handling these types of transactions and helping people handle their transactions. A little bit of biography information. I've been a licensed CPA since 2011. This is the get to know you stuff. I've been licensed since 2011, but I've been practicing since the beginning of 2009. So this is my 17th year practicing. I can't believe I'm saying that out loud. Time does fly pretty quickly. We participate in the AICPA and the Texas State Board and stuff like that. I went to St. Thomas, and that's where I got my bachelor's degree. Took my CPA test here. Not very crazy story. Just went to school, got my licenses, started working for a local firm, got married, had kids, all the typical stuff. Mr. Runkey is very similar. We don't have a bio page for Mr. Runkey.
I don't have one. Oh.
I don't know if that guy got pulled out of there, but it's going to be shockingly similar.
Oh, that's a big letdown. But you can probably follow his bio, and you get about to where I am. I've been licensed CPA since 22. I've been working in the field of public accounting for 7 years. I was a member of the AICPA. I'm not anymore. But I also went to the University of St. Thomas. There I got a bachelor's in mathematics, followed by an MBA in 2018. But I followed all that with the licensure, a CPA license in 22. So, yeah, very similar stuff. I got married. We had kids too.
Yeah, Chris has got 3 kids. I got 3 kids. It's almost the same bio except for the length of practice. Yeah. That's kind of us in a nutshell. We run a small firm on the west side. We're over here in Cypress. This is the 7th year of running the firm. And we do have someone who works with us as staff, so there's 3 of us total. That's kind of us in a nutshell. So the agenda, the things that we want to talk about for investors, for real estate, and you'll see most of this is investor stuff. Some of the record keeping stuff is not necessarily investor stuff, but we're going to talk about it anyways. We're going to go through cost segregations. We're going to go through that. We're going to talk about LLCs. We're going to talk about LLC best practices for real estate, 1031 exchanges, common deductions for real estate investments, general record keeping tips. Investors usually are okay on that, but if you've got a new investor or something like that, they might need tips and tricks. And then we'll talk about S corporations a little bit, but that's primarily for realtors and not real estate investors. S corporations are not a fit for holding rental properties because there's no tax benefit. So we'll touch on that just very briefly, but this is a multi-purpose presentation that we've got. Really big thing that affects most investors for real estate is cost seg studies. This is one of the most impactful things that when you have real estate and you want to save some money on your taxes. So cost seg studies, what is a cost seg study? Like, explain it to me. Like, you've never heard of one. When you go and buy the real estate, you pay a price for the real estate. So you as an investor, or your client who's an investor, they go, I like to pick big round numbers. They spend $1 million on a piece of property. And the cost segregation study is an analysis of the various components of the real estate property, breaking out like what each of the components are. So to be specific, it's things like, okay, how much is land? How much is HVAC? How much is plumbing? How much is electrical? So each of the various categories. Those categories are actually much more detailed than that when you do a cost seg study. But I'm just giving some high level examples. When you break those categories out, it's very helpful for tax purposes because certain categories get better tax treatment than other categories. So this is what really can impact an investor's tax return. The big stuff, the building, that's going to be depreciated over a long period of time. But the smaller categories, appliances as an example, even commercial buildings are going to have appliances. Commercial buildings, residential buildings have appliances. Appliances can be depreciated much quicker than you depreciate a residential rental or you depreciate a commercial property. So when you take that $1 million and you break it up and go boom, 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 here's what we have as a makeup of the $1 million that we spent, like what makes that building up, we can then get much bigger depreciation numbers on the tax return for that property. So there are companies that do this, and they're very good at it. And I'm a little bit more here talking about the categories, just briefly switching back. So the tax categories that get better depreciation is the 5-year, the 7-year, and the 15-year categories. So the cost seg study is all generated around, they want to break out as much as is reasonable into those 5, 7, and 15-year categories. The 27.5 and 39-year categories in land, not quite as helpful, but your structure exists. So it's got walls and a roof and things like that. So you have to have purchase price allocated to those things. But when we split it up and you get your charcuterie board, if you will, of different categories of the real estate, now you can get a better result on your taxes. Now the mileage is going to vary. We're not talking about any one specific person's tax return. I haven't seen a tax return for a given investor. How much the depreciation is going to help an investor is going to vary on their tax return. So I can't guarantee that a cost seg is a fit for a given purpose or a given person, but they are generally helpful. And so this is just a visual aid here. This kind of shows. Actually, let me mark this as a presentation. See if you can see that. All right, can y'all see? You see my whole screen? A little easier to look at. I'll take the silence as yes. So this visual representation is just to show, like, this is the charcuterie board I was talking about. So you've got your building. Now it's either residential at 27.5 year or it's a commercial property at 39 years, and then you have the different categories we talked about. So breaking this up is what the cost segregation companies do. This presentation is, we wrote it a couple years ago. These facts are actually all still good because the bonus depreciation rates have not changed. Those categories that we spoke about, the 5, 7, and 15-year categories, can get bonus depreciation. Right now, bonus depreciation is not quite as lucrative as it was. When we had 100% bonus depreciation, if you spent money on one of those categories, 5, 7, or 15, you could have deducted 100% of it several years ago. That category has gone down. So now in 2025, for instance, if you allocated $100,000 of the purchase price of this $1 million building to 5-year property, you could take 40% of this as depreciation in that year. So it would net you a $40,000 deduction. So that is beneficial. And Congress is constantly working on things, and they're talking about extending bonus depreciation and increasing it to 100% for this year. We haven't seen that yet. So that the law hasn't passed. To borrow the phrase from Trump, I guess as it was, the big beautiful bill hasn't passed. So since we haven't seen that yet, it hasn't passed, we can't count on accelerated depreciation. in as large a percentages as it was in the past. Now, that doesn't mean that it's not still beneficial to do cost segs. If you have a very expensive commercial property, it can still be very beneficial even at the 40% rate. Next year, it's going to be less beneficial. Like if we're only getting 20% bonus, it's going to make much less sense to do a cost seg in a given year unless it's a bigger property. So this is just a recap of the current year. After that, like if you have a 5-year piece of equipment or something that's attached to the building, if you get to take 40% of it in the beginning, you get to take the rest over the rest of the 5 years. So this is actually very the bonus was very lucrative, and then now it's phasing out. It's literally phasing out as they wrote it in the tax code.
So these cost segs, they were far more lucrative, years ago. Than these, cost seg businesses were booming. But currently, their interest is extending these bonus depreciation laws. Keep them in business and keep them real busy.
Yeah,
and make it real lucrative. But right now, it's getting worse and worse, and it's less. Saves you less in taxes with each year that goes by. So it's not as lucrative as it once was on the tax side.
Yeah.
But still, in our opinion, worth doing.
Yeah,
as long as the numbers work.
Yeah. Now that's something I do want to talk about. Practically speaking, the companies that are going to do these cost segs, they're going to be selling their services for a price, and they usually justify their price based on how much taxes they're saving. So when you are having somebody prepare or quote on or give you working numbers, we're going to do a cost seg for you. You have to take that stuff with a grain of salt, because we have seen cost segregation studies that are too aggressive or that they're not couched in reality. And so if something doesn't exist in the building, we can't allocate depreciation to a given category if it doesn't actually exist. So, I'll use one example to kind of make the point. If you got a cost seg study from a company and they said that 10% of your purchase price was landscaping improvements, and this qualified you for 10% of the $1 million or $100,000 of landscaping improvements, which would give you better depreciation. And you're thinking, this is great. I'm going to get a large amount of depreciation on this property. But if there's no actual landscaping improvements, so if you go look at the property and literally all it is grass, grass, for instance, is non-depreciable. So grass is included in the basis of land. So one of the things that we caution is if you are interested in doing a cost seg, you need to kind of work through and fill out a couple different companies to make sure that they're going to be giving you something that's reasonable. Because if they give you a report and if it's factually incorrect and you put that in your tax return, or your investor puts that in their tax return, they're potentially going to have a problem, because you still are signing the tax return after the person has, provided that cost seg. So it's important that, you can't put something in the return that just literally doesn't make sense. It's like, well, we don't actually have landscaping, but we're going to depreciate it because it saves us money. You can't do those types of things. Most people don't ask for those types of scenarios where they're saying, please give us something that we can't do. But the reason we're drawing attention to it is we've seen it so often with the cost segs that you have to approach the cost seg. It's a tool. Like the tool is, it can help me write off more depreciation, but I've got to follow that tool up with, I need to make sure that whoever's giving this to me is going to give me something that's realistic. So,
caution too is, if you are having your tax return prepared by a CPA, they need to agree with it as well. They can't completely take it with blind faith. They need to agree with that because they're signing the return as well.
Yes. And from our standpoint as CPAs, we do actually look at the cost segs, and we will do a little bit of investigation to make sure that it makes sense. The example about landscaping and grass, that's actually a real practical example. We were providing cost segs for a particular client, and there was a stupendous amount of money that was allocated to landscaping, but there wasn't any. We were able to check the visual view from Google Maps and Google Earth, and to show that there's no landscaping out there. That's just us doing a little bit of due diligence, to make sure that what we put in the tax return matches reality. So the CPA needs to be okay with it, and then you need to be aware of what's in the report. You can't just blindly accept it. It's very important to be aware of all of the different pluses and minuses of these cost segs. But on the whole, we'll say that they are usually very beneficial for larger properties. They're going to be less beneficial for smaller properties. So, if you're buying like $100,000 property, you might not want to spend a couple $1,000s trying to get a cost seg done, because the cost versus the benefit might be a lot closer. So each situation is going to be slightly different. So those mathematics can work in a different time frame.
We can go back real quick. Just,
Sure. Yeah.
Have you seen price stuff? Can you talk to that, or you want me to chip in from what I've seen? As far as commercial properties, I mean, the kind of a rule of thumb, the old rule of thumb was maybe $1 million or so. Commercial property, it can go lower. And as far as pricing goes from different companies, I've seen it at least around $10,000, if that's fair. But definitely can get up from that too. So that's just a general rule of thumb. On residential, speaking from experience, is something I've seen in the last couple of years. It was more like $2,000, $2,500 a property. Again, that's within the last few years, that could be increasing. That's just a general rule of thumb. And there's going to be some sort of cost benefit. Break even, number, depending on how much you paid for the property to begin with. So that's also something you consider. But just, I'm sure it's a question out there. If anybody's not going to ask it, just kind of like how much these things actually cost. From a professional. There are plenty of firms around Houston. I've seen them come from all over. So I don't have a specific one that I say, you got to use this one, or a specific reference, but I'm sure you can Google it and find, 20 of them in Houston. No problem.
I think Keller Williams has a relationship with some people who do cost segs and stuff like that. So I don't think they're hurting for contacts, but we do like to talk about this at length, because when you're talking about real estate, this is one of the most impactful things that you can do with taxes. Following this, I'll touch on this one more. We're going to bump forward, go back, bump forward, go back. Please be patient. We do want to give one more comment. Occasionally, if a client is building a new facility, like if they're building something brand new, they can get information from the general contractor and have the cost seg basically come from the general contractor's prices. So if you're doing a new build for a commercial facility, or like an office building or something like that, and you're the one who's paying the general contractor, they can very easily break out the components for you. They'll do it most of the time as a courtesy. The reason this is helpful is because you then don't have to then pay someone to have and do a cost seg study, because you just built the building. Significant renovations is also another time when that's approached. So I just wanted to touch on that very quickly.
Josh, real quick.
Yes, sir.
If the contractor provides that breakout for you, do you not need a cost seg study to provide, for example,
yes, that's exactly what I'm saying. Like, you can use that in lieu, because the person who built it is telling you what they spent.
Okay, and then we just give that to you for tax purposes?
Yes. So if you had a significant renovation, for instance, like if you had a residential property that needed, $100,000 worth of work, well, you can get the contractor to tell you what he spent, what was the $100,000 worth of work on, and then we could use that instead of having a written cost seg. Like, the reason the cost seg studies are popular is because it's a nice written, well done report, but you can break this information out yourself if you have the information available. And so I constructed, with a business partner, we built a shop several years ago up in Pinehurst. And because we were the general contractor, we constructed it ourselves. We just kept track of the categories as we built it. So I was actually looking at that paperwork before our phone call. But since we built it ourselves, it's like, I don't need a cost seg. Like, I did this myself. So I broke out the depreciation categories because we built it. So that's perfectly acceptable to do that. It's very accurate when you do that, because the contractor who built it, they quoted each thing that they do for you. But that's the last part I want to talk about that.
Cool. Can I do one more?
Sure. We're never going to end.
Just the last thing on the timing of it. The sooner you can get the ball rolling, the better, because, these things aren't, turned around in a week or so. Like, it should take them longer to do this. So I can't imagine turning around in under a
No.
few weeks or a month or something like that at best.
No, that's a salient point. In terms of timing, the year that you put a property into service, like if you buy a property, that you want to have that information for the tax year that you're going to be filing for. So if you bought a property in 24 and you're filing that tax return in 25, you need that report ahead of when your tax return needs to be filed. You can go back and amend after the fact. But when you go back and amend and you've already filed the return, it slows down the process of any tax savings. So new properties are, and when I say new, I don't mean brand spanking new. I mean new to you. So if you buy a property and you're wanting to do a cost seg because you're investing in the real estate, the time to start that is probably when you acquire the property.
Yes.
So that's timing is important. We've had clients go back and do a cost seg for a property that's been in service for 2 years, and then we go back and amend 2 years worth of returns. We've done that several times, and that works out just fine. But we have to amend more returns. We have to go back to the year that it was placed in service. There's a longer process for doing an accounting method change to do a cost seg, but it's even more time consuming and costly than it is to do an amended return. We're not really going to go through that because it's so complicated and expensive. It doesn't usually make sense to do it. It'd be different if you were talking like a $10 or $20 million project or something like that. But most of the reach that we have for real estate is usually small office, small industrial, small residential, and those price figures aren't really applicable. But talking about acquiring real estate, we want to switch to the next topic, which is LLCs. LLCs are very common, and every attorney, this side of the Mississippi is going to tell you the same thing. Anytime you buy real estate that's not your primary residence, you need to be buying in an LLC. We're not attorneys. We're not going to pretend to be attorneys, but that's still good advice because it protects either you or the investor into the real estate from anything that happens. So the general recommendation there is you probably should have an entity to protect it. The primary benefit is forming an LLC for significant holdings is prudent because it protects you if someone sues you because something happens at the property. Someone trips and falls when they're walking in the property. Something egregious happens while they're habitating in the property. You have a renter or something like that. Someone's walking down the sidewalk in front of your retail storefront and they trip, and you're responsible for the sidewalk and they sue. Having the property in the LLC protects you from your personal liability because when it comes to real estate, if it's in your personal name, there's no limit on the liability. You have unlimited liability for real estate. So that means if anything happens and they get a judgment, they get to come after all your stuff, which is, generally speaking, you don't want that. So that's why LLCs are so common. They're not stupendously expensive, so it's not price prohibitive to sort out properties into an LLC. So it's a really good recommendation. Practically speaking, depending on who owns the property, if it's a single person, it's not going to affect the tax return in a significant way. If you have more than one person and it's a partnership, you were probably being pushed into an LLC anyways because you needed an entity. But it does not make your life significantly harder by having an LLC. If you have a residential property that you're renting and you buy it in an LLC, it's not making your taxes complicated. You just have to file Texas franchise returns to keep your LLC license open. So the general gist here is it's recommended. It's helpful for liability. Most if not all attorneys are going to recommend that. Just kind of generalistic items about LLCs. We do it. Attorneys do it. We have clients who do it themselves. You can pretty much tackle this any number of ways. You got to get a tax ID, you got to form it with the state, you got to pay a fee, and then you got to get a company agreement set up. We at our offices, we do that for $1,250, which includes the board report. The board reports are voluntary now, depending on the type of ownership structure. If you have a foreign owner, that's still required. But that's just a little peek on like getting one set up. I'm not going to dig deep on the board reports because they're voluntary for most people. But I do want to talk LLC best practices. Practically speaking, if you're going to buy a property and you want it to be an LLC, you need to get the LLC set up before you buy the property. We've had new clients come in after, and they're like, I bought a property and then I have an LLC and I'm running everything through the LLC. And if you don't have the LLC on the title, it doesn't own the property. Writing the lease with like a tenant through the LLC, but the property is owned by you personally, that does not give you any benefits of liability protection. So the LLC's got to set up before you do the real estate transactions.
Mm-hmm.
The practical stuff, you need to keep your documents. You need to keep your closing documents. If you're going to have an LLC for real estate, it's really important that you have a separate bank account for the LLC and that you run the business transactions through there, and that you need to keep records. We obviously love it when someone keeps a set of books. A set of books is not a requirement if you have a rental property, but something that can equivocate a set of books, like a spreadsheet, a notepad, something to keep track of your income and expenses for the property. Obviously, keeping the receipts is the investor or your responsibility, but it's really important to keep some kind of coherent record. For the lion's share of real estate, if it's a rental property, you're not having a stupendous amount of transactions. So you collect rent once a month. You have a couple bills every year. Typically it's like the property taxes, maybe 2 or 3 entities for your property taxes, your insurance, HOA dues, and then you might pay the note once a month, but it's probably an automatic payment. So the actual documentation, unless you have to pay for some repairs or something, is relatively light. So we do recommend that you keep good records. Everybody's going to always recommend that, but because most rental properties, either residential or commercial, the number of transactions is so low, it's not hard to keep track of it. Mm-hmm. So you want to stay on top of it. Would you like to?
Sure. I can chit chat on it. So continue here. So what are some tax implications of holding things in LLCs? They don't shield you from tax. We get that sometimes. You'll hear people say, "Well, I own a company, so I don't pay tax." Well, no. Still pay tax. So it'll shield you, from liabilities, but not your tax liabilities. So that's still something that you need to be concerned about. That's still going to come no matter what. And I think we mentioned it earlier, but depending on the structure, it could be just completely reported on your original tax form, your 1040, or it could be structured differently if you had a bunch of investors. And this might be split up as a partnership, which would require a separate filing. So it really depends. LLCs are flexible and they can be, structured a lot of different ways. So it's just, but when you set up initially, that's something you should be aware of, about how it's going to be reporting its tax information. Business activities, we make a note in here about having ordinary necessary expenses that go through LLCs. As far as real estate, we went through all the details about what those might be. Primarily insurance, property taxes, interest, like your mortgage interest, HOA stuff, like we mentioned that. But in a general sense, for general business, that's the IRS definition, and that's the reason we included it here. So those aren't the only deductions by any means that we mentioned that are allowed, but it's just, the income or the expenses have to be ordinary and necessary to that type of business. So that is a little open to interpretation, but we like to use the example of if you're going to write something off and you're trying to explain it to an IRS agent,
sitting here like this,
sitting right here, if it makes you nervous and you're wiggling in your seat, then it's probably not ordinary and necessary to your business. Yeah. So that's just a general rule of thumb. If you can follow that, you'll probably be on the right side almost every time. Yeah. And the last piece there, we say accelerated and regular depreciation allowances are beneficial. So that's just talking about the cost seg stuff and using the accelerated options available to you under current tax law. And hopefully they'll stick around, but 2025, it is sunsetting to some degree. So
yeah, let's see what we got next year. Okay, yes,
I got a few questions for you.
Please.
First, where do you see in addition to the LLC, where do you see an umbrella policy fitting in?
It's a good idea. Typically, the actual contents of a building is usually handled by your tenant. So I'm going to talk through a couple different types of insurance since you mentioned insurance.
Yeah.
So the contents of the building are usually captured by the tenant. The structure, your casualty, is usually carried by you. The supplemental insurance, where you say, look, we're going to go ahead and have an umbrella insurance. And that's a good point. Thanks for bringing it up. The umbrella insurance is going to cover you in case something happens at the property. That type of umbrella or general liability coverage can cover more than one property. I highly recommend it. It's a good idea. So from a practical matter, having an umbrella policy that covers your real estate, even for a single, residential rental, still a good idea. So you're mentioning it. It's like, what about this? We recommend it. It's a good idea.
Okay.
Typically, the company that covers the actual building itself, like if you have State Farm and they cover your residential rental, if you call them and say, I need an umbrella policy to cover this rental, they can sell it to you. Doesn't have to be the policy offer that you buy for your insurance, but typically whoever you're getting your insurance on your casualty can offer you some kind of umbrella policy. If you have more than one property, you can get your policy to cover multiple properties. So that's something that's entirely possible. But that's really practical. It's also a really good note if you don't have a property in an LLC for practical reasons, like let's say it was your primary residence and then you've moved out and you weren't able to get it into an LLC because there's a note on it. It's very common to say, look, I'm going to throw $1 million or $2 million liability policy on it to protect me from the property because I can't get it into an LLC right now in a practical way. Mm-hmm. Because there's a lot of investors who, they'll rent out their primary residence and then move out. And they'll move out and then rent it. Got that switched. Okay. But when they do that, typically that mortgage that was on the property when they bought it, it stays, and you can't transfer a property to an LLC for most mortgages. That's not all. There's a couple mortgage servicers that will let you transfer your property to an LLC with their permission, but you can't do it without their permission. That's very clear. But to answer your question, we do generally recommend it. What other questions do you have? You said you had a few.
Well, I have one more, and it's kind of two questions in one. It's my understanding that having investment properties in an LLC can actually protect you in both directions. Meaning if somebody gets hurt in my personal residence, they can't go after the investments as well as the other way around. Is that correct?
Like we mentioned before, I always love to answer the questions. We're not attorneys, but my understanding is yes, that is beneficial both directions.
Okay.
So insulating properties by putting them into LLCs is beneficial. Talking about that is a good opportunity to bring up, do you do an LLC for each property, or do you do a few properties in an LLC? It's preference. An attorney is going to tell you every property gets its own LLC. Whether or not you do that, or if you put a couple residential properties into a single LLC and then start a new one when you have more than a couple properties, it's preference for the investor. It's preference for the person who's doing it. The buy the book answer you're going to get from the attorney is going to be everything gets its own singular LLC to protect the maximum amount possible. That's expensive. It makes the attorney a lot of money. And the realistic, what we usually see is somebody's going to keep a couple properties in an LLC, and they'll cap out based on how much they feel is in there. And then after that, they'll make a new one. So that's what we practically see. I will tell you, just general recommendation, property types is really important. So if you have a residential property, you generally don't want to commingle it with like a commercial property into the same LLC. It's different types of exposure, different types of liability. Residential rental is going to have one person in there. An industrial or, an office building or a retail space is going to have lots of people visiting it daily. There's lots more incidents of potential liability exposure. Mm-hmm. So keeping those types of property separate is pretty helpful from a liability standpoint. So even though it's really an attorney question, we see enough of it and be like, we can go ahead and answer and kind of tell you what we see about the whole ticket. What else you got?
Well, and the last thing was kind of related. It's my understanding that a homestead exemption on a personal residence protects the homestead in the case of a lawsuit. Is that the case, or am I just misunderstanding?
That one I can't tell you. I've answered. I know a lot of stuff. I don't know enough about that.
Okay.
So I do know that there are protections for your homestead, but I don't know if that's tied to the homestead exemption. So that's a great attorney question.
Okay.
I'm going to sidestep it.
Yeah.
Sure. Thanks.
Sure. So going to 1031 exchanges. 1031 exchanges are very, very, very beneficial for investors. It's a very highly talked topic. It's very helpful for taxes. And to be very specific, if you have a property and you want to sell it, and you want to stay invested in real estate and you want to buy a different property, that's what this is for. So you sell a property with a bunch of gain on it that you've had for a long time, and you want to replace it with other properties because, let's say you've heavily appreciated gain in a particular property and you want to get it sold. And then, you bought a property in a great place 15 years ago, it's quadrupled in value, but it's only got one renter. And you're like, look, I'm going to sell this thing and then I'm going to replace it with 8 properties and I'm going to have 8 renters now. And so that's what the benefit of a 1031 exchange is. You can sell real estate and then replace it with real estate and not pay taxes on the sale. So that's the whole point.
Right. And to be clear, it is business property. So you're operating has a business purpose to it. And that's what you're using it. So when we're talking about this, we're not talking about like your homestead.
Correct.
Or your house. Like that's its own category.
Yep.
Not really applicable here. But yeah, this is specifically something you're renting or, you're leasing out to somebody.
Yeah. And it doesn't have to be an actively leased property. It could be a piece of land you bought for investment.
Mm-hmm.
And you could sell different types of property for other different types of property. You could sell a residential rental and you could purchase like an industrial facility. You can do that. So you can cross the types as long as they have business purpose. You could go from land, which is investment property, to rentals. So you can do a couple things like that. This is very helpful because frequently property will appreciate, which is almost what the entire realtor profession is built upon. Mm-hmm. Property values go up, houses get sold, you guys make commissions. So the ability to do this saves a significant amount of tax. Typically, and the reason we say typically, because there are caveats, typically no tax is recognized on the transaction as long as the transaction's handled properly. You can't get cash out. If you get cash out, you have to pay taxes on it to the extent that you get cash out. That's one really big one. So there's also the size. If you sell $1 million worth of property, you need to replace it with $1 million of property or more. You can't sell $1 million of property and replace it with $500,000 of property. They don't let you go down. In that particular example, what I'm talking about is, let's say you have $1 million property and it's got a $500,000 loan on it. So you have $500,000 in equity and you want to sell it. And then you take your $500,000 in equity, pay $500,000 for a house, and then you don't have any debt. You can't do that. They don't let you do that. So whatever debt levels you had for the property that you're selling, you have to maintain those debt levels for the property that you're replacing.
Yeah, or else you get caught.
Yes. Mm-hmm. So you can sell a property and replace it as long as it's of equal value or greater. If you sell a property with the debt attached to it, you can replace that as long as the debt that's replacing it is of equal or greater. They just don't let you go down. They treat it like they treat it like you got taxable gain. So that's why you have to be careful about it. Now, I will tell you, there are a lot of 1031 exchange companies. So the 1031 exchange companies, they get paid to handle these types of transactions. And so the very, very fine minutia detail of what you can and can't do for a 1031 exchange, like when do you identify a property? How long do you have to buy? What are the time frames? All those types of things. The 1031 exchange companies are paid to do that. So we always push their detailed questions over to the 1031 company because that's what they do every day. Mm-hmm. We're familiar with those rules and laws and things. We talk through them in generalistic terms, but there's even reverse 1031 exchanges that you can do. Mm-hmm. So we're not going to talk about that. But those specific mechanics, typically those companies are very good at answering those questions. We try to push them over there. So we've got the layman's understanding, which is you sell a property and then you replace it. Now, what are the mechanics? You have to use a qualified third-party intermediary. I don't know how many of y'all have watched The Office. This is not a deal where you can just declare bankruptcy and be like, I'm bankrupt. You can't just declare 1031 exchange after the fact. So you can't sell a property and then 6 months later independently purchase another property and then go, I declare 1031 exchange. I wish you could. You have to do it together, and it has to go through a qualified third-party intermediary. What does that mean? That means if you sell your first property and then you're going to replace it, they get your funds, they impound your funds. So you sell, and then the funds are escrowed with the third-party intermediary. And then when you go to buy the replacement property, the funds are dispersed from the third-party intermediary. So you do not have control of the funds at any point in time. So you can't sell it and collect. You have to go through a third-party intermediary. It's absolutely required. There's a couple things we've listed here. You're supposed to identify the new property within 45 days and document it. You're supposed to obtain the replacement property within 180 days. We talked about business. It's got to be investment or business, and then it can't be for your primary residence, as we mentioned. There are exceptions to the property that you identify. There's exceptions to timeframes. There's extensions and things like that. But those specific exemptions and details and stuff, we push those types of questions to the 1031 exchange company. Because when you set up, like, they walk you through it. Like, you have to document everything with them. They're going to tell you what you can and can't do. So if something's getting done in an obscure way, or if you have a very, very specific question, we typically recommend, like, just call 1031exchange.com. They're going to help you with these things because they want to do it for you. This is for real estate agents. We're not going to go through it. So I'm going to skip back to general record keeping. So unless you want to talk more about 1031.
No, the last thing I want to say about 1031 is fees. They'll charge you something for their services.
Yeah.
But it's very minimal, I think, for what they're doing and how impactful it can be.
Yes.
On your taxes. But I've seen it around $1,500, $1,000. So nothing crazy.
Yeah.
And they just take that out of the funds, the proceeds from the real estate sale.
Yeah.
So it's all very easy to do. And I'm not sure how many of you guys would have seen them or done them before in practice, but it's not bad.
Yeah. I usually see $1,500. It used to be $1,000, and then I usually see $1,500, $2,500. If you have multiple properties, like let's say if you sold one property and you bought like 8 replacements, they're probably going to charge you more money, which isn't a big surprise. But the actual mechanics of that price, it's really low. And so it's usually worth it. We'll talk just a little bit more about the 1031. There is, just like how we talked about cost segs, there's a practicality level. If you have a property that has like a $10,000 gain on it, like that's it, like you've got a $10,000 built-in gain, and you go to sell the property, the taxes on the $10,000 is going to be roughly equivalent to paying the 1031 exchange fees. So there's a point where if you don't have enough gain, it's not practical to do the 1031. So, and if you're planning to do that, and it's like, well, this only saves me $2,000 worth of tax, but I had to spend $1,500 to do it. You're like, I'm probably not going to do this for $500 savings, because it's a significant amount of effort in order to accomplish the 1031 exchange. It's not impossible, but if you have to express the effort and then pay some money for it, if your benefit is not a slam dunk, you might not want to do it. Other things that we do recommend is, what is the investor or your ultimate goal in the property? So if you're selling a property and then, ultimately the replacement property, if you only wanted to hold on to it a very short period of time, it might not be beneficial to do a 1031 exchange. If you sell your property and then you're planning on selling the replacement property the follow-up year, it's not really moving the needle. So timing can be an impact on whether or not you do a 1031. The amount of gain that you have can impact whether or not you're going to do a 1031.
Another one piece I was just thinking about, cost segs do have some overlap with 1031s. So that is a consideration too. If you're flipping a property quickly, cost seg isn't your best option there, because like you're going to create just a massive write-off in that first year. And then subsequently, if you sell, you create a massive gain, when that happens from a tax standpoint. So those will need to be offset if you're doing something like that. So the two areas do have a lot of overlap, and they impact each other significantly. So,
so these types of scenarios, like the cost segs, the 1031 exchanges, typically what we do a lot with clients, investors, people like you guys, is we try to talk through the transaction. What are your goals for the transaction? How long are you going to hold the property after you replace it? If you're doing a cost seg, how long are you going to rent it out? Do you plan on selling it next year? So all the qualitative things that go along with the property can help impact the decisions you make for a cost seg or for a 1031. If you're planning on selling a property in 2 years and be like, we don't want you to do a cost seg. You're going to pay money to do a cost seg and you sell it in 2 years. So you move depreciation from 2 years to now, and then you paid a bunch of money to do that. So timing of holding a property can affect whether or not you do the cost seg or the 1031. What these are the best fit for are like long-term rentals, long-term properties. Like if you're going to hold a property long-term, doing a cost seg is great. If you're going to hold a property long-term, doing a 1031 is great because it saves you from paying tax for a long period of time. You sell a property for $1 million, you replace it with 4 rentals, and you plan on holding those rentals for 10 or 20 years. That's a slam dunk for doing those types of things. But frequently we'll have people call us and they won't tell us what the ultimate goal is. And so we try to pull it out, like, tell me what's going on so that we can have an understanding of the full transaction, not just the tax consequences. Because the tax answer can be, yes, this makes sense. Let's do this for both cost seg and 1031. But, if you start looking at the other factors that can affect it. Going back to general record keeping, you want to keep receipts, you want to keep closing documents, you want to keep entity documents, you want to keep the titles and deeds. You want to hold on to everything. Your investors, like, you got to hold on to stuff. Your receipts for a given year, typically the recommendation is you want to hold on to those for 7 years. Your permanent file stuff like company documents, closing statements, titles and things like that, it's typically recommended for as long as you own the property plus a substantial amount of time after that. At some point, if you've sold the property, you don't need to hold on to that closing statement until the day you die. That's not necessary. Like if you sold the property 10 years ago, like there's a point you can get rid of it. But the recommendation to hold on to like titles and closing statements is longer because it's a critical document that can be lost. Receipts, you can call your credit card company and try to get it back. Closing statements, title companies can and do fold up and disappear. So you can lose access to a closing statement if a title company gets eaten up. Like if you close at a small title company and they get bought out, and when they get bought out, they didn't do a good transfer of documents. We'd like to think that we live in a digital age and everything's recoverable, but you have to plan for I need to hold on to these things. So those general record keeping, it's a good idea. This is just general advice. Business tax returns, you want to hold them up to about 6 years. Payroll tax returns, at least 4 years. I'm going to skip over the employee stuff, job applicant stuff. Ownership records, which is what we just spoke about. Formation documents, minutes, bylaws, things like that. Deeds should be retained permanently. At some point between 0 and the heat death of the universe, you can get rid of those documents if you sold a property, but it's hard for us to tell you exactly when. If you sold your first house 15 years ago and you hadn't lived there for 15 years, you could probably get rid of that. But between 0 and 15, I don't know exactly when to tell you to get rid of it. Accounting records and receipts is about 7 years. Your operational records, bank statements, credit cards, things like that, still 7 years. I do want to touch on one item. I usually talk about it when we talk about business records. So if you pay for something on a credit card and you have your credit card statement, that is not considered substantiation for the IRS. So you actually have to have the receipt. So, you pay $500 for office supplies at Office Depot, and it goes on to your Chase card, and it shows that you spent $500 there. If you get audited, you give them your credit card statement, they're going to go, we want the receipt. So it's the requirement is to keep the receipt. So that's pretty important.
Yeah, and it's not. I mean, it's very, very, very tough to do in practice. I know everybody, gets a receipt. It's probably in the trash as soon as you get home. But from a business standpoint, we will always advise you to, keep and maintain those in a paper file somewhere. Josh does his here in the office, and it doesn't take up that much space, I promise.
No, it doesn't. A lot of the things that we pay for, the receipts are small, the paper's thin. You can keep your receipts in a paper file for an entire year, and it doesn't take up that much space. So I do really recommend it. But the reason I'm harping on that is we frequently will hear feedback from people telling us, "Oh, I've got my bank statement and my credit card statement. I don't need receipts," and that's not accurate.
And from a very practical sense, like we've seen that with the IRS, and that is the be all end all is having an actual receipt.
Yes.
And showing what you purchased when, at that time. So, it's not enough to bring out your credit card and just highlight the line where you spent the whatever it was on the office expense. But
now that doesn't mean that receipts aren't lost occasionally. If you have 100 receipts and one's missing, the IRS agent is probably not that upset. But if you have 100 expenses and you only have one receipt, you're probably going to have a big issue. So we just want to mention that. So the general record keeping stuff, general advice there. The S elections, this is more for realtors. We're not really going to dig into this, but I do want to say S elections are not effective for real estate. It doesn't save you anything. So real estate, the type of income that real estate generates, rental income is not subject to self-employment tax, which means a S corp is not going to be beneficial in any way. Every once in a while, we will see somebody who has an S corp that's holding real estate. We never understand it.
Right, and it's really the extraction of assets that makes it almost impossible.
Yeah. So for real estate investing, we do not recommend that. And then for us, not a big surprise. We offer tax return prep, tax estimates and planning, simple LLC formation, financial statements, QuickBooks assistance. We do some bookkeeping, and we do some contract services to fit specific needs. And then we do miscellaneous, like sales tax returns, tax franchise returns, little things like that.
Yeah.
So does anybody have any questions or anything that they want to go through that we did not talk about? I think we hit our hour.
Josh, I have one question for you.
Yes.
Earlier, you had mentioned that if we have bought the property, investment property on a personal name and want to convert it into an LLC, it's not a good idea unless and until we change the title also to the LLC name. Can you a little bit expand on that?
Yes. So if you bought a property in your name and you have a mortgage attached to it, it makes it very difficult to transfer it to an LLC because most mortgages contain a clause that if you transfer the property, it breaks the note. So
if there is no mortgage associated with it?
If there's no mortgage, then there's no issues with transferring, a rental that you have in your name into an LLC. You just have to do some paperwork at the county. So if you have paid off properties and you own them personally and you don't have an LLC, it's very easy. You can either have an attorney do it or you can go down to the county courthouse and do it yourself. I've done it once or twice. I went to Montgomery twice to do transfers. It was very easy. So for that, it's two answers. One is if you have a mortgage, it's very difficult to try to get it transferred to an LLC because most mortgages don't let you do that. Not all, but most. And then if you don't have a mortgage on it, it's paid off, it's in your personal name, and you want to transfer it, man, that's a prime property to transfer it to an LLC. We do recommend that.
Okay, thank you.
Yeah, you're welcome.
Well, Josh, I think you covered everything. I'm sure there'll be 100 questions after the fact when I share all this with our agent population. Include your information so anybody who needs to can do follow-up questions with you.
This is our first time doing it remotely that I can remember. We usually do get some more presence when we come into the offices, but we still like to talk.
Awesome.
Yeah.
Well, I certainly appreciate you. I appreciate you both taking the time to do this. Hopefully they'll send you some business soon.
Well, you'd appreciate it. Thank you very much for having us.
You bet. Thanks, Josh. Thank you. Bye, guys.